Joining me now to discuss the key takeaways of the past year are Norman Willemin, he's the CIO of UBP, Thomas Heller, the CIO of Schweizer Kantonalbank, and Lars Kalbreyer, the CIO of Vontobel Wealth Management. Welcome, gentlemen. To kick off, let's first of all remember the biggest moments of 2018. Which was the biggest moment to remember for you, Norman?
I mean, for me, it was back in May when the U.S. actually rejected the offer of the Chinese to buy more U.S. goods to stave off tariffs. I mean, that really signaled to me that this was going to be a long-haul trade battle rather than short-term.
Thomas, for you, if we have to rewind the past year, which was the key moment for you?
I think the most remarkable thing for me was when Fed boss Powell said that we're not far away from neutral in early October, which, among others, caused the turmoils in October, and then kind of stepped back from that in late November, saying we're close to neutral already.
And for you, Lars, the biggest moment to remember of 2018?
Well, it was definitely Davos, January 2018, when Trump decided to attend on short notice, and when you had the biggest US delegation ever. We knew something big was going to happen, and that was when the US announced its new trade doctrine, and that has been accompanying us the whole year.
Absolutely. Now, Lars, staying with you, volatility was the name of the game this past year. Investors looking for more diversified portfolios. We had widespread overvaluation of a lot of stocks as well. What kind of lesson have you learned?
Well, we started the year by telling our clients, do not expect returns like 2017. That was exceptional. In the CIO letter, it was expect more volatility and lower returns. We didn't expect the returns to be that low and volatility to be that high. Key reasons for that was certainly central banks starting to remove liquidity, starting with the Fed, but then exacerbated by the uncertainty over trade. So you asked a question about diversification. Usually diversification works in a historical content. This year, it just hasn't worked. There was no place to hide, with perhaps the exception of US stocks, which are almost flat, but all the other main asset classes which you have in a diverse portfolio did underperform.
You mentioned the US-China trade war, and we talked to you, Thomas, about that quite extensively. Let's listen back to what you had to say earlier this year about the US-China trade war.
Go into both directions, although I think it will go in kind of the right direction, because there's no interest neither from China, nor the US, nor Europe to let this become really bad. So I think they will find solutions, and ultimately this will give a bit of a relief in the market as well, although I think most is priced in that things will turn out well.
You sounded very optimistic back then that the two sides will find a solution. Where do things stand now, and how will this impact your investments?
Apparently I was wrong, at least to some extent. I really didn't expect that to escalate that far as it now at the end of the day did. I had to realize that it's not about economic rationality. It's a political thing, and I underestimated that part of it. And so the escalation went on, and now I'm not really sure whether it's going to turn out well. We have some relief now after the G20 summit and the meeting between Trump and Xi, but I'm really not sure whether those 90 days will really solve the problem.
Still, we had the biggest and longest ever bull market this past year. Norman, if you have to recall some of the best performers, in the equity market, which ones would they be, and what kind of sectors were the biggest performers? I
mean, really, if we're honest about it, there was only one performer this year, and that was the U.S. tech sector. And that was very strong going into October. In our view, it got actually quite overvalued by that point. And then we've seen that unwind over the course of the last few months. But outside of that, I think, as Lars has pointed out, it was very hard to find positive returns anywhere else across the markets in 2018.
We had a blockbuster Q2 earnings season, especially in the US, despite the tech stocks plunge that we've seen later on in the year. Which were some of the best and most attractive stocks for you, Thomas?
I mean, to be honest, we don't really look at this individual stocks. That's because of our client don't really care about the stocks outside of Switzerland.
But do you agree with Norman?
But I agree. I could add for Switzerland, I mean, at the end of the day, the pharmaceutical stocks did pretty well, held up pretty well. They were the defensive part, and they played their role pretty well in the last couple of months and quarters.
We had this tech stocks plunge, as I mentioned, in October. Lars, you had an interview here on the show when you commented on that as well. Let us listen back now to what you had to say a bit earlier this year.
Now, what's interesting, if you look at the fundamentals, both companies are doing well. If you look at Amazon, the business model itself is a very strong business model, and it's a business model which not only works in the US, but which is gaining market share all over the world. Having said that, if you have a company which has been so successful, we're talking year-to-date 20% performance, over the last 6 months 40% performance, and the stock has doubled over the last 2 years, then when you have a risk that a president is looking at antitrust laws against a company, then the risk-reward is changing. And therefore, it makes sense to take some profit on that stock and wait until the storm has receded somewhat. If I look at Facebook, for instance, it's a great company. It's fairly cheap. We're talking about a price-to-earnings ratio of 20 times, which is slightly higher than the market, but with earnings which are growing 5 times faster than the market. Having said that, what we do not know is, will there be regulation? How many users will delete their Facebook accounts? And will advertisers still pay as much in order to use Facebook for advertisement purposes?
So, Lars, 2018 kicked off well for tech stocks, especially the FANGs, Amazon, Netflix, and the likes. But then we had this big share plunge in October. What do you say now, looking back?
I mean, now again, they're looking much more attractive than used to be the case before October. In fact, you had corrections of 20%, perhaps even 30% into some of the tech stocks. If I look at Apple, for instance, has been a darling of the stock market, and it has very much corrected over the last month or so. It's now trading at forward price-to-earnings multiples of 13 times, 13. If we look at the S&P 500, it's now trading at over 16 times. For that, with a company which has an extremely strong brand name, a very loyal customer base, stronger growth than the S&P 500, and a much stronger balance sheet. Therefore, it's interesting again.
Norman, in the portfolio construction, we cannot ignore the geopolitical tensions and protectionist fears that we have seen in 2018. How did that impact your portfolio, and how did you reallocate some of your portfolio?
Really, we've taken two approaches to portfolio construction in this kind of environment. One, I think what we wanted to focus investors on was really keeping them focused on the underlying economy, which was quite strong. And as we saw in particular in the US, the underlying earnings story was quite strong. But then recognizing those risks were in place, really we took two steps. One, we looked much more to the alternatives universe than we have in recent past. And then secondly, we were using options, we were using capital protected strategies to protect against unusual downside driven by these kind of geopolitical tensions.
Really hedging the risks, that's a key point. What did you make of the investor attitude this year, Thomas? Do you agree with what Norman is saying?
Yeah, I agree. First, I have to go back to 2017. We were skeptical already then. We proved to be wrong, actually. The markets went up pretty much, but we went really defensively into 2018, which helped quite a bit. Then end of January, early February, to be honest, unfortunately went a bit too early back into the market. We expected volatility to be high, but we didn't expect that collapse we had, or that correction we saw in October. So we're pretty neutral overall in our asset allocation, but went in, as I said, too early after we went after that correction in early of the year.
And what was the main reason? Is it the Turkish lira crisis, Italy, Brexit? What were some of the biggest factors that you counted and took into account?
Yeah, you mentioned some of them. I think trade war, or the trade conflict, kind of a sort of Damocles over it all. Back in June, as you heard just earlier, I was pretty optimistic that they will solve that problem. But afterwards, in September, October, when you realized that will not be solved pretty fast, markets started to react on that. And I think that's a big difference to 2016 or 2017. We had political issues back then as well. Brexit, Trump election, North Korea, monetary policy turning around and stuff like that, but markets didn't react. And I think that's the big difference to in 2018, markets started to react on political issues.
Let's talk about another asset class, which is Forex. And we had the US dollar seeing the best yearly performance since 2015. Lars, was it a surprise for you? And what is your outlook for the greenback?
Well, I think the key reason why the US dollar did appreciate so much in 2018 was because of the yield differentials. In fact, remember 2017 was the year of convergence. I think 2018 was the year of divergence in terms of monetary policy. We've had the ECB and the Bank of Japan and, of course, the SNB as well being on hold and continuing to be on hold with very low interest rates. And in the meantime, we had the Fed increasing interest rates multiple times. Therefore, the yield differential was extremely supportive for the dollar versus other currencies and has accelerated the rise of the dollar. Now, I think you asked, what is our expectation going forward? Here, we do not think that the Fed will be as aggressive this year as it was in 2018, or next year than it was in 2018. And therefore, the yield gap differential is unlikely to widen much further from here. And that means that the dollar most likely has peaked.
Do you agree with the pace of the US Fed's interest rate hikes, Norman? And do you think that they're on a good track for 2019?
I mean, we think the Fed is going to be finished by mid-year in terms of their hiking cycle. But we think that at least for the first half of the year still means the dollar is strong, not because there's any surprise in the Fed policy trajectory, but really more because there's more uncertainty across every other axis. So whether it's sterling, whether it's the euro, we think there's enough uncertainty geopolitically in terms of what's happening domestically on Brexit, in terms of Italy, now in France and Germany, as well as EU elections, that should probably keep pressure on both those pairs as well.
It also wasn't a really good year when it comes to US treasuries and gold, right? How were the precious metals doing this past year when you recap?
I mean, we were quite negative on gold entering the year, largely because of the Fed policy. The real interest rate, the opportunity cost of holding gold was just rising. The supply-demand balance, it was okay. But we think the gold picture starts to ease and get better as we move through the year end. And so now's the opportunity for investors to start looking at gold again as an interesting asset class.
Also because some economists are projecting a fresh US recession that might be a little bit overdone. Thomas, do you take this into your strategy as well, the likelihood, even if it's minimal, of a US recession?
I think the likelihood is really minimal. There will be a slowdown. I think that slowdown has already started. But I think the Fed will only hike twice next year. Probably that's your view as well.
Some people say 3 times, but 2-3 times, that's the range people talk about.
Not the 4 times we'll see at the end of the year with the next hike next week. So I think they will manage to have a soft landing in the US, so a slowdown, but far away from stagnation or even a recession.
Lars, are you as bullish or maybe a little bit more pessimistic when it comes to the US economy?
Well, I certainly would agree that you will see a slowdown. In fact, some of the strong stimulus which you had because of the tax cuts is now starting to recede somewhat. It's still going to be supportive in 2019, but less so than in 2018. Yet I believe that the likelihood that we'll see a recession, is low. Having said that, if you have a full-blown trade war where both sides, the US and China, are then going to loggerheads, then that could precipitate a recession for 2019. But bearing that, and we also believe that there will be a deal in due time, we do not think there will be a recession in the US.
agree. It's a fine line between a positive outcome, just purely a slowdown, and a possible recession if this escalation goes on with the trade war. I think that's really, I mentioned the word already, a sort of Damocles. So it's a fine line between everything going well and a stagnation or a recession. But I think it will turn out well.
Let me also talk a little bit about the banks here in Europe. We had, for example, Deutsche Bank, which had a pretty tough ride so far this year in 2019. Do you expect the banking sector to face more headwinds going into the new year, Lars?
Well, usually the banking sector does well when the yield curve steepens. That is something which hasn't really happened this year. We do not see that much of a steepening also for next year. On top of that, European banks have some structural issues. Many are big conglomerates, and it's quite difficult for them to have strong growth. And on top of that, the regulation has very much changed for banks, and therefore the growth rates are not as high anymore. All that in economies which are slowing somewhat. That's why the European banks is much more difficult than for American banks, for instance, who have less regulation as well.
Talking about businesses and the corporate sector, Norman, we had a lot of corporate scandals as well this past year. For example, Tesla, Nissan, Facebook, Huawei most recently. How did this impact investors?
A lot of our investors are spending time focusing and increasing their focus on ESG, and especially this governance aspect. And so increasingly, as we and other investors allocate via ESG, these types of scandals are going to be much more important in terms of how we decide that we like particular companies in terms of how they're making decisions. So I think it's going to be much more important going forward.
So in Switzerland, Thomas, where should investors look for value? Is it still the pharma sector that you mentioned at the very beginning, or is it more the, the banks? Maybe not really. Is it tech stocks? Is it transportation, consumer goods, defensives?
I think the last word is the correct one. We would stay defensive overall. So that includes pharmaceutical sector. And we have reduced our portion in small caps. So they have made quite a good run until the correction started. So we're on the defensive side in the Swiss stock market. Small caps, not the cyclicals, and more on the pharmaceutical side.
Lars, this past year, where did you see investors make the biggest cash? What was some of the, where were the sectors that made the biggest gains and the biggest rewards?
On a relative basis, it was still probably US tech. That was the only sector which gave you a positive performance, even though it was a very positive performance until mid-year and then came down somewhat. So, but if you look at other sectors, there was no other place to hide. Now, what was interesting, if we look at more the Swiss markets, recently, the very defensive stocks, such as the healthcare stocks, have done also very, very well. Almost too well, I would say.
So do you expect them to come down in 2019?
I think they were very much a safe haven assets, and people moved from mid-cap stocks and small-cap Swiss stocks into the major ones, and especially the major ones in defensive sectors, such as, again, healthcare or consumer staples. Now, if we believe that there will be a resolution over the trade spats between the US and China, let's say in the first quarter of next year, then that would be very good for cyclicals. And some small and mid-cap cyclicals have lost 20 to 30% within a few months. They look attractive again.
Before we go to each of you, which was the biggest investment lesson learned in 2018? Let me start with you, Norman.
When we talk to our clients, one of the biggest lessons they learn is you can lose money investing in bonds. I think for a long time on this bond bull market, people thought, bonds are safe. I get my coupon, I get capital gain. 2018 was a year where you had to learn that bonds would get volatile too. An awakening lesson for sure, and it can hurt your portfolio. Thomas, for you?
I think we always tell our clients be diversified, and I think that's still a good advice, but it didn't help that much this year. No place to hide, not even in bonds. So I think that was a lesson to learn. You can lose money in almost every asset class at the same time.
And Lars, to you, last but not least, a lesson learned in 2018?
Well, unfortunately, at the risk of being boring, right, I can only echo that. I mean, usually a diversified portfolio protects you against moves, market moves like we had this year. Unfortunately, this year is a very rare year. In fact, you didn't have that, for the last 22 years, that so many sub-asset classes had negative returns. And therefore, diversification, which is usually helpful, didn't really help this year.
Thank you so much for joining us, gentlemen. There's much more to come here on the Swiss Pulse, so don't go away.